Thank you, Nanette. It's a pleasure to talk with you today about our work that documents what happens when brands stop advertising for long periods of time. To start, I want to make it clear that this work is about broad reach mass media advertising, which is sometimes called brand building or equity-based advertising. And our data predominantly captures brand spending on TV. And this kind of advertising doesn't typically drive strong, immediate aggregate sales changes. It reaches out to many people who will not buy for many months, and so its effects are spread thinly over time. And that means it can be challenging to clearly show the contribution of this kind of advertising to the bottom line, and that in turn puts budgets at risk of cuts or even being taken away entirely. So in this research, we chose to focus on complete advertising cessation, or when brands go dark, which is an extreme circumstance, but we felt it warranted investigation because we could see many brands stopping advertising for 3, 6, 12 or more months at a time. And stopping advertising isn't likely to lead to decreased sales within weeks or months because the effects of past advertising carry forward, but the expectation is that without continued advertising support, sales for a brand will eventually slip into decline. We could find only limited evidence that quantified how common or drastic declines might be. And for a few studies that collectively report about 150 zero-weight tests, which are controlled in-market experiments where advertising continues as normal in one region and is turned off in another. For about half of these tests, interestingly, there was no significant difference between regions after 12 months. So these brands seemingly pocketed the savings from advertising without any real consequences. And we were curious if we could replicate those findings with a different method and document what happens if advertising stops for more than 12 months. And we wanted to explore factors that might help us understand why some brands decline without advertising and others don't. And we specifically looked at a brand's size and its trajectory before it stopped advertising. A manufacturer of alcoholic beverages gave us our data, which logged annual volume sales and advertising spend by media over 20 years for 70 competitive brands in the Australian market. And our analysis was a simple descriptive approach. The first step was to identify the stops, which we classed as zero or near zero spend in a full calendar year. And for each case, we converted the sales figures in the unadvertised years to an index, measuring the proportional change in sales for each year without advertising relative to the last advertised year. And indexing in this way meant we could directly compare different sized brands and assess the rate of change over time. To determine prior trajectory, we applied the same process, just backwards, showing whether sales were going up, holding steady, or going down in the presence of advertising before the stop. And we found 57 cases from 41 brands that stopped advertising from anywhere between 1 and 10 years. And mostly we focus on the results for the first 5 years where we have bigger sample sizes. And for each condition, we put cases into 3 buckets based on logical cut points. And as you can see, the groups are similarly sized, which is important because it means our data is not biased or limited to any one type of brand. And it also means that it's not only declining brands that stop advertising or troubled brands. So to show you the results, here we have the 3 prior trajectory groups in the prior year, which converge on a baseline index of 100 in the last advertised year. And from that point, we can see an average reduction in sales of 16% in the first year without advertising. And obviously there's a lot of spread around this average, ranging from 75% growth to 97% decline. So by no means is every brand the average, which is important to acknowledge. But moving forward, sales after 2 years were 25% lower without advertising on average, 36% after 3, and 58% lower after 5 years. Beyond the averages, I wanted to show the commonality of decline without advertising. So after 1 year, just over half of cases declined in sales by more than 10%, which we considered in decline. And that is consistent with the findings from the zero weight tests. And that compares back to, well, only a third of cases were in decline before advertising stopped. Looking at conditions for brand size, the most notable result is the average proportional decline was consistently less for those large brands. And we expected big brands to be more resistant because of their well-established market-based assets, and also because the proportional changes will naturally appear less extreme coming from a larger base figure. But meanwhile, small brands suffered more immediate and steeper declines. Splitting by prior trend, previously growing brands and stable brands stayed stable on average for the first 2 years without advertising, and from that point, declines were more likely to set in. And unsurprisingly, sales declines continued for brands already in decline and were deeper compared to the other groups. We also looked at the interaction of brand size and trajectory, and an interesting finding emerged for the growing group. All previously growing larger brands continued on an upward trend after advertising stopped, and advertising was resumed for these brands after 1 or 2 years. But quite differently, most previously growing small brands, well, they immediately flipped trajectory and dropped below the base year after 1 year without advertising. So our key findings were, we observed that when broad reach advertising spend was stopped, many brands did lose sales. But average declines over time were rather moderate, showing that many brands didn't exponentially fall out of the market without advertising, like the aeroplane analogy that I shared earlier seems to imply. But at this point, it's worth noting that not only advertising affects sales, obviously, and this is not a controlled experiment. We did not have data on the other activities brands were doing or not doing over this period when advertising stopped. So we cannot say that stopping advertising caused the observed declines, but I will say we found it quite remarkable that the results are as clear as they are without these controls. Small and already declining brands are more at risk of declines without advertising. And in the case of already declining brands, you might think that those marketers were clever. They avoided spending money on brands doomed to die. But in some cases, it could be a self-fulfilling prophecy. So detangling when support should be pulled due to genuinely changing consumer trends versus a marketing team that has lost faith following a couple of poor performing campaigns, well, that's a real practical challenge that should be scrutinized and well researched. Larger brands as a group and also previously stable and growing brands were relatively unaffected when advertising was removed for 1 or 2 years. And this speaks to a possible opportunity for these kinds of brands to save money on advertising and thereby improving profits. But the flip side is we don't know if these brands might have grown or grown more had they not stopped broad reach advertising in its entirety. Removing advertising support from small growing brands had the most radical changes. They quickly became small declining brands, which tells us that broad reach advertising seemingly helps small growing brands to fulfill their growth potential. In terms of how we explain our results, we suggest mental availability theory is a good fit. That without refreshment from advertising, the capacity for buyers to think of a brand erodes. So mass advertising, which reaches out to even the lightest buyers of a brand, and they make up the bulk of a brand's customer base, is necessary to maintain the accessibility of the brand in memory, linked to those category purchase cues. So based on these findings and other research, we recommend brands adopt a continuity strategy where a fixed advertising budget is spread over longer periods of time to better be able to support brand performance and by eliminating those dark periods.